welcome on board then Pankaj Tibrewal and find out what he's making of the current market construct. Pankaj, hi, morning. Good to have you on the show. Yes, important event today, the RBI MPC outcome. But that said, a lot of pain seems to be behind us, and the market prices as well are reflecting that. The fact that FIIs have turned buyers consistently for the last 4 trading sessions. Yes, crude is again volatile, but looking at the price action, the fact that we are back at 17,600 now actually on the futures doesn't seem like it's bad going at all.
Good morning. Absolutely. If you have been hearing us, we have been cautious on the markets for the last almost 10 to 12 months. And we believe that now market peaked at about during the month of September 2021. It's almost 18 months that markets have given no returns. And if you adjust for the earnings growth during this period, which was about 16 to 17%, and on dollar terms, markets have actually corrected by on a relative basis 16 to 20%. So I think next 6 months will be a very exciting time. We believe that from here on, valuations have started to look a lot more reasonable. A lot of froth from the broader market is out, and the next 6 months will give us great opportunity to start increasing the equity allocation. Uh, Always remember there are certain milestones if you go into the history, which we have been watching out before actually market bottoms out. History suggests that there always is one credit event. We saw that happening last month where 4 banks, 3 in US, 1 in Europe, actually going down. And that was an important one. The second milestone we normally track is that markets don't bottom out before earnings downgrade cycle of 10 to 15%. In Nifty, this time we have seen about 5 to 6% earnings downgrade already. Our sense is that next 2-3 quarters, probably markets would, built in estimates which will be lower than where the current estimates is for the broader market earnings as well as Nifty earnings. And the third point is that normally we have seen market cap to GDP bottoming at about 65, 70 or 75%. And today we are at 90%. So I think in the next 6 months, looking at the uncertainty, and if we reach these milestones, markets would give us great opportunity to increase our equity allocation. So our tone of cautiousness has started to reduce. And we believe that next 6 months should be used as an opportunity to increase your equity allocation and expect returns in 2024 and 25.
Right. So, Pankaj, you've always been known for, spotting stocks, spotting sectors that have corrected a lot. They are in neglected zone, and within then, probably you choose the first 2 leaders. So approach continues to be the same. Stick with companies that have larger market share in the sector and which sectors have been neglected. Is that the approach that you continue to follow?
Absolutely. I think next 6 to 8 months will be a great time from a bottom-up stock picking because the contours of broader macro, construct is very strong. And I believe that many companies from here on over the next 5 to 10 years will become very big in size, provided we pick up the companies carefully. And my sense is that manufacturing is one area where we have been positive on. And we believe that it's a multi-year growth story. And kind of changes we are seeing at the ground level makes us believe that many of the winners of the next cycle will be from this space. Also, financials continue to do well. Selected NBFCs and private sector banks where we are positive on. The third sector where we are incrementally evaluating and almost 4 to 5 years of price as well as time correction has happened and valuations have started to turn attractive is pharma. And we believe that there are many good quality companies with strong balance sheets and cash flows there. And selectively, we are evaluating pharma as a incremental investment space. Also on a cement, we believe that incrementally things have started to turn positive. The cost pressures have started to ease and the outlook on profitability has started to improve. And this is one sector where going into the next couple of quarters, we could see earnings actually being revised upwards rather than downwards. So I think these are the 4-5 places where we are trying to hunt for the best of the companies and from a bottom-up stock picking approach.
Right. Pankaj, I was wondering you would put, last time around you were very bullish on banks, NBFC. I mean, last time means in the previous cycle. And of course, NBFCs did quite well till the ILNFS issue happened. This time around, your view on NBFCs, you believe that NBFCs can do well? Some of the names are really beaten down.
I think in this space, what has happened is that distinction has happened between good and bad. And clearly, the consolidation has happened in this space. And there are very high quality NBFCs of maybe around 4 or 5 of them. And some of them are part of our portfolio also. So we believe that yes, the consolidation has played out quite well. The strong players are now existing and they will continue to grow over the next 3-5 years. And there are some monoline businesses in this sector. So, for example, vehicle financing, rural financing, commercial vehicle financing. All these, if you want to play, some of the NBFCs are in a very good spot, and valuations have also corrected. So, I think it's a great time because the interest rate cycle is looking to peak out in the next 3 to 6 months. And some of these wholesale funded NBFCs will be beneficiary once you start the interest rate cycle coming down.
Okay, fair enough. Pankaj, hi, morning. Let's also get in your take as to what the outlook is when it comes to the entire pharmaceutical space, because the theory or the thesis is rather that you're being very selective here. So what exactly is it that you're looking for in the companies that you invest in?
So in the pharma sector, what we have seen for the last 3-5 years is that US has been a spoiled sport. You have seen consolidation on the buyer side in US, and that has led to pricing pressure for most of the companies in the US market. What we are incrementally looking at is that the Indian business continues to do extremely well. And there are many companies which have very strong franchise in India. And it's like an FMCG, quasi FMCG business where cash flows are strong, return on equity in the Indian business is extremely strong. And they generate quite a bit of profits from the Indian business. So that's one part where we are extremely positive on companies which have a dominant share in the Indian market. The second one is that in many companies, what we are seeing that along with Indian business, they have the US business. And if you do the valuations today, the valuations are only pricing, valuations for the Indian business, and US business is either coming free or maybe slight negative in some cases. And there we are seeing that as incrementally we are seeing data points, the price erosion has started to come down. Earlier, we were seeing high single digit of price erosion, and that's now settling at 4 to 5%, which is quite okay. So the incremental change in the US is actually turning out to be positive. And because of last 3-5 years not being so good, many small and marginal players are vacating that space, which will be very, very positive for serious players out there. And the pricing will, kind of consolidate. So I think that's where we are looking at that, which are the companies where you think that incrementally things are changing better in US, and from a valuation perspective, market is not subscribing any value to the US business now, and it's not there in the price. And hence, we believe that this will be the way we are approaching the pharma sector. The second approach is also to look at for the pipeline of many of the US generic companies. And some of them have very strong pipeline for the next 3-5 years. And we have started to look at the value which can be from a medium-term perspective. And hence, we see that there are some opportunities from a bottom-up basis on the pharma sector as well.
In terms of FMCG, do you see a similar sort of a move? I mean, they have, of course, not beaten down names, but for years, they have not done anything. Like 3-4 years, HUL price and Nestle price is probably similar to what it was 4-5 years back. And earnings, of course, have grown marginally.
Absolutely. So incrementally, in some of the consumer names, we are turning constructive. We believe that, 2020, a large number of names in the FMCG sector peaked out. And from there, we have seen a very subdued performance, courtesy, subdued earnings growth. Incrementally, what we look at, there are 2-3 data points. One, I think the gross margin pressures, which were led by the raw material index, has started to turn positive for most of these companies. And over the next 3-4 quarters, we should see incrementally gross margin actually improving for most of the FMCG companies. The second one is that rural has started to show some signs of revival. And don't forget that uh, next year, May, we have the election. And if you go into the history, 6 to 8 months before election and 6 to 12 months after the election, this is one sector which generally does well because money gets spent at the lower of the pyramid on the rural areas, and that actually translates into consumption for most of these companies and good revenue growth. So we believe that FMCG sector selectively can be looked upon, and recent updates which we saw from a couple of companies were quite encouraging, which came over the last couple of days. And we believe that from here on, the worst is priced in, and incrementally we should see better revenue momentum and better gross margin momentum going into the next year.
Right. Pankaj, the other space that I wanted to talk about with you is also cap goods. You know, I mean, as large an umbrella as it may be, would you say that stick to the more top-up stories, more the L&Ts, or would you say that, you know, this is pretty much a broad-based call that you have on the sector, and, you know, just about any pocket is going to be lucrative even at the current levels?
So we believe that India is going through a major transformation on the industrial side and manufacturing side. And that makes us believe that it will be a broad-based recovery. And many of the cap good names, including the large ones, will be clear beneficiaries of that. And we are seeing it that for last 18 months as well. In between, there may be some volatility because of the order inflows and stuff like that. But structurally, I believe that private sector capex has started to fire, which was not the case for almost a decade. Uh, you know, for a very long period of time, we were stuck between that 5 to 6 lakh crores of private sector capex annually. If you look at from a trailing 12 months perspective, we have already crossed 7 lakh crores. So I think that's a very encouraging sign. And if you look at some of the annual reports of some of the MNCs, which have been released over the last couple of months because they are calendar year ending, they clearly mention that we are shifting a part of our plants from Europe to India, and India will become the manufacturing hub for the rest of the world. I think if many of these corporates follow this policy, it's not only the import substitution, but also the export opportunity which will be knocking at our doors. And I think these are some of the themes where the broader economy will participate. Many of the cap good names, whether it be serving to energy sector or the green hydrogen or the incremental consumables, will be beneficiaries out of that. And we continue to remain positive on the broad overall capex recovery theme. And capital goods is, I think, a great proxy to play that revival.
It is, Pankaj. So great to have you on the show. Thanks as always for
Thank you.
taking the time out.
Thank you so much.